How do most successful investors you work with use hard money to scale larger portfolios?
This is a really good tip. This is what I've found for investors that are looking for good deals. Look for stuff that's been sitting on the market for 6 months. There's a reason it's on the market. People look at hard money as this fill-all, and it's this big bucket that we just push anything that doesn't fit somewhere else into. And in reality, it's just one tool among many. And a lot of times the financing and the project don't match. I think the biggest mistake from the investor side is not understanding the risk.
Are you relying on traditional lenders while other investors are scooping up deals fast? Welcome to Real Estate Hackers. I'm your host, Dave Hathaway, here to help you scale faster and smarter. Today, I'm joined by Josh Weidman from Hard Money Bankers, and we are breaking down when and why to use hard money, how to fund deals faster than your competition, and what mistakes investors make when borrowing and how to avoid them. If you're actively investing right now or just starting out, this episode could literally save you thousands of dollars or help you scale your portfolio. So with that, Josh, thanks for joining us today, sharing your experience. Before we dive in, can you give us a quick background on your real estate investing experience and how you got involved with Hard Money Bankers?
Yeah, absolutely. Dave, it's really a pleasure to be on the show today, and love talking about real estate. So this is fun stuff. So I have never been a really good employee. It's probably my weakest trait is, working for somebody else. So since I was 16, pretty much worked for myself. When I went to college, I went to the University of Maryland, and my best friend from high school had this roommate at Delaware by the name of Jason Balin, and we met one summer at the beach or something like that. And anyway, we were very like-minded, both entrepreneurial, and so we became pretty quick friends. We ended up fast forward, and it was December of 2006, we bought 3 houses together to rehab. And so went into the first one. We're buying at probably the worst time in history to buy a piece of investment real estate, especially flipping houses. So we bought 3 properties in subprime markets, lost money on all of them, and, did it consecutively and didn't really realize until we were, we're done with the first and deep into the second two that this was not a winning proposition. One thing that Jason realized is that, hey, the only people that made money on these deals were the lender. Maybe we're on the wrong side of this transaction, right? And so, he and his friend Chris Haddon, also partner, they started Hard Money Bankers, and that was in spring of 2007. I beat my head against the investing wall for a lot longer. About that time, I ended up wholesaling a deal from a guy that used to work for me, made 30 grand on the assignment, and I was like, this I can do all day. It's a lot more simple than flipping houses. So, I followed that path, wholesaled a bunch of houses in Philly, picked up a few rentals along the way, ended up, as the market shifted, it became really difficult to make money in wholesaling because nobody had any equity. So we started managing properties and built a nice sized property management company, sold that in, 2010, something like that. And my partner Ian and I opened up a branch of Hard Money Bankers in Philadelphia. About that time, was doing some, flipping properties and investing, worked for private equity for a little bit. And long story short, right before COVID, my parents are getting a little older. I'm from Hershey, and, my parents live in Palmyra, and I was talking to my wife, and, we decided we wanted to relocate. Anyway, relocated to Central PA, and then COVID hit, and it was, in retrospect, it was fantastic, but we opened up the Hard Money Bankers office here in Central PA, and we've been lending ever since. And it's been quite an experience. I mean, my biggest adjustment was going from looking at deals as an investor to looking at them as a lender. And it's a completely different experience where, oftentimes investors are walking into a deal looking at the potential. They know what they can do. They understand, they know their team of contractors and property suppliers and how much they can sell this thing for. Whereas from a lending perspective, I don't know what your finished product's going to look like. I don't know how good your contractors are and how consistent they're going to show up and all that kind of stuff. So there's a lot more uncertainty and a lot more risk coming in from the lender's side. And it was a little difficult for me to look at this and say, well, my ARV is X and theirs is Y. And what's the difference here? Why do we have that discrepancy? But it's been really great. I love the real estate industry. I love helping investors, leverage their capital to do more deals and, make more money. And that's really our job as lenders, is help, put the right type of loan together with the right project and the right investor. And if you do that, a lot of times, everybody wins.
Oh, awesome. I love that. So you're coming full cycle experience on the investing side and on the lending side. So you have a little bit of a different perspective,
Yeah,
kind of the total perspective on real estate investing. With that said, let's just start with the basics. Not all money is created equal when it comes to real estate investing, whether
yep.
it's cash, whether it's conventional loans or hard money. So what exactly is hard money? And how is it different from conventional?
Sure. All right. So hard money is kind of a slang term, right? And the hard part of that is not the application process or the dollar amounts or, the cost. It's based on a hard asset. The idea is that the loan is based on the collateral primarily. Now, that is not entirely true because, believe it or not, no lender wants to go through a foreclosure and take back your property. We just don't want that, right? So, we do look at the quality of the borrower and experience and things like that. But ultimately, if you have $1 million in your bank account and, have 850 credit and you want to borrow money against a crappy property, I'm probably not going to lend it to you. And vice versa, if you have $1 million property and terrible credit and no money, I'm sure there's something we would lend, and so it's a little bit different criteria than going to a bank, where they're first going to look at your credit. They're going to look at your bank account. They're going to do some other underwriting that have nothing to do with the property. And then based on, your credit worthiness, they're going to lend you money, and the property kind of is a side variable, where a lot more is dependent on your income and your, credit and things like that. So hard money, you asked me, what it is. We basically fill a gap in the market, right? If you go to a local bank and the property you're trying to buy doesn't have a heater, or in some cases even a stove in the kitchen, or the place needs a lot of work, I mean, nobody's going to lend on that. No conventional bank is going to lend on that. There are plenty of nationwide hard money lenders that do they do loans that are really similar to more conventional financing, but they also take time that is like conventional financing. A lot of times I find my foot in the door with a borrower because somebody else dropped the ball, whether, they got to close by the end of the week, 5 days before closing, their broker stopped responding to emails and, went dark on them, or the lender comes back and says, oh, we appraised it and the appraisal didn't come in what we wanted, or, hey, there's the place is rural, we're backing out of the deal. There are a lot of factors that go into an investment project that will, kind of kick it out of that box of conventional financing that we've become really familiar with in this country, whether it's an investment property or it's a single family home that you were moving into. There's a lot of money outside of bank financing. And, I tell people when they call me all the time, like, look, there are thousands of ways to fund a deal. You can fund it on credit cards if you have enough, lines of credit and the deal's good enough. You can go to the bank and get a loan, and everything in between is a possibility. We're just one of them,
Yeah.
and if it's the type of thing that we can help you make more money, great, let's talk some more. But if I can't, like, it's probably not a good fit. That's it.
Yeah, it's interesting. I never thought about it of being you're basically like lending on the business itself.
Yeah, I mean,
If you think
right.
of the property as a business, you're lending
Yeah.
on the business itself than the actual borrower. I do want to caveat there. I know you mentioned, hey, the property doesn't have a heater. Technically, even if you're moving to the property, you can still purchase these things conventionally. It's just with a conventional loan instead of a Fannie loan.
Fair enough. Yeah.
And so you can do it. You're also putting a lot down. So if you're doing a convention, at least when I used to do, that's how I started out. I was using conventional loans in my first, 7 properties. I think I did conventional, 20%, move on to the next one, 20%. But you have to have money built up to do that. That's the only way you can do that is you are a saver, you have money built up, you're selling a property to put money back in because you run out of those 20% down payments pretty quickly if you're buying. So there is, and you're right, it does fill this awesome gap. Who is hard money like a good fit for, and who is it not a good fit for?
Well, let's start with not a good fit, because that's the easiest one, right? If you are buying a house to move into, hard money is not going to be a good match. I get multiple calls every day from people that are, have some misconceptions about what hard money is. I'm sure there's somebody out there that loans on a primary residence, but these loans are commercial loans. They're intended for not necessarily commercial properties, but commerce. Okay. So if you're buying the house with the intent to rent it out, or you're buying it for an Airbnb, which you are not going to spend more than 1 week a year living, visiting, right? There's some pretty specific IRS caveats, right? If it's a multifamily commercial property or a retail space or industrial, if you're looking to flip the house, all of these things can be funded with hard money. But if it is a vacation home for you and your family, if it's the house that you're living in, that falls outside. For us, we're not even licensed for consumer lending. So it's a really important part of our underwriting process to make sure that this is not a primary residence that they're going to be moving into. What type of properties are best for hard money? I mean, there are a lot of products out there for stabilized rentals, or even properties that with plenty of vacancies that are residential rental properties up to 5 units. I think Kiavi even has a DSCR product up to 5 units. So like there's a lot of funding out there for that. That's not going to be competitive with hard money. I mean, it's going to be preferable to hard money a lot of times with a purchase where you don't need to do a lot of repairs on the property for a rental. And so, when people call me about that, we do work with people on DSCR funding, but it's more of a supplemental part of our business. Most of the time people call me, I mean, we are best when there is an element of timing and a need for certainty. If you're bidding on an auction property, we fund those kind of deals where we can determine before the auction, this is what our loan amount's going to be. Here's about what, you're telling me you're going to buy it for and what the renovation costs are going to be. But we can give certainty to, okay, you're putting down 10 or 20% on the day of the auction, and in 30 days or 15 days or 10 days, you need to have the rest of those funds. So people use us there. Or where, I mentioned where somebody, we're talking before the call, somebody calls me a week before settlement, and, the house is rural. I mean, we do a ton of funding in Stroudsburg and in Tobyhanna, a lot of the other Poconos areas where you have a decent population, like a decent sized population, but it's less than 10,000 people. And so automatically, boom, it is a rural property. It's not going to qualify for 90% of the funding that's out there. And typically our loans are going to be a portion of the purchase and all of the renovation funds. So when there is a large budget for rehab, that's a good use. And we work with people that are, whether it's their first deal or their 100th deal. But, before the show, we were talking about some like case studies in different situations. The nice thing about a local hard money lender, or, if you call me, I'm going to be underwriting the loan. Right. So you can ask me questions like, why are you only lending this much? Well, here's what I see in the data. This is where the numbers play out. And this is where, why we can loan what we can loan, whereas you're working with somebody that's a national lender, they might be slightly less expensive, but you don't have an approval until like 2 days before closing, and where our approvals, 20 minutes, an hour of underwriting and research, you can have a letter of intent with all the steps, all the costs, all that kind of stuff in front of you, and then make a decision one way or another. And it's my partners, Jason and Chris, they've done such an amazing job of building this company. Our home office is in Columbia, Maryland, and that's where most of our staff is. And like our back end is phenomenal. So much so that like since 2007, when we opened, we've never missed a closing date. We never had to bump because something changed last minute or, whatever. It's the dependability and the certainty of closing, it adds a lot for our clients. And that's why people call us.
Yes. I mean, speed is definitely the hugest part of hard money and why people often use it. And if they just straight up don't have infinite amounts of cash, eventually, if they're scaling a rental portfolio, they will have to use some sort of they'll have to use one of these niche funding because they'll just run out of funding, and the bank's not just going to give you a random line of credit just because you're a good investor, at least not that I know of, where it's like, hey, I have this flipping business. This is my P&L. Will you give me like $1 million line? That would be amazing. But I have not heard of that happening. Maybe it does. Somebody can comment in the box like, hey, I have this $1 million line because I'm such a good flipper or whatever.
Listen, I'll take that too. Let me know when that funding comes.
So what's the biggest concern you hear from investors about hard money? Why they don't use it to scale?
I think you're asking two different questions. So the first, I'm going to answer the second one first. Why don't they use it? I think oftentimes people think of hard money as a cure-all. I've got bad credit and I don't have any money. I'm going to use hard money. And, for a little bit more expense, I'm going to be able to fund this whole deal. And the truth is, we can work with people in a lot of different situations. I have clients that have 520 credit scores. They also have 7 properties that they own free and clear that are renovated and rented. That's a totally different conversation. But the point is, it's never one thing. But at the end of the day, I think that people look at hard money as this fill all, and it's this big bucket that we just push anything that doesn't fit somewhere else into. And in reality, it's just one tool among many. And a lot of times the financing and the project don't match. And so when that happens, it's pretty evident. It's, the rates are too high, the leverage is too low, the this, the that, the other thing. Well, I mean, that's a pretty good indicator that that's not a good match. And it's okay. You can make a lot of money when you've got the right project, you got good execution, and you have the financing that is right for that project. But it would be silly to take a 6-month loan on a project that's going to take a year. Right. And it's the same type of scenario. You'd be silly to start a construction project that is going to cost you $80,000 with only a $40,000 budget. And so it's the same with financing. You'd be silly to start a project that it's the only financing, but it doesn't really fit.
Yeah, there's 2 things that I just want to note there that you haven't said that are important for the audience, that is a benefit to any good lender. I mean, it doesn't necessarily have to be a hard money lender, but me speaking to hard money lenders, I've heard this often. You basically get like a partner that vets it's basically like a second person looking over your shoulder that vets your deal, that says, yep, you're good to go. Everything looks good here. In your shoes, you've done investments. So you can say, hey, I don't think this works here.
Yeah.
This is why. And so you get this kind of cool partner as an over the shoulder big brother. This doesn't work. And that's who you want in your corner. You don't want like, hey, I'm kind of hoping you fail so I can take the property back. That's definitely what you don't want. Like, I'm waiting to see you fail. And most hard money lenders don't want to take that property back. And so that's why they will say, no, I'm not lending this because I don't agree with your numbers. And that's should be a good thing. The best money that we make is money that, maybe the deal that we didn't do. We're like, oh man, that would have been a super big headache for X. So it allows you to just get that partner or that somebody else that can double check your deal, which is always a good thing. Any lender should do this in essence, but I feel like hard money lenders do a little bit better of a job because their money's at stake and it's not like a corporation or a company like a bank, B of A or a Wells Fargo that's like, doesn't really matter if you fail. I don't have to worry about taking the property back.
Yeah.
That's just one of the things. And the properties the deals that people are doing, what is the typical deal? Is this a value add deal that's what hard money is made for? Is like, hey, this value add property, I'm purchasing, I'm fixing it up, and then I'm either flipping it or I'm doing a DSCR and it's going to be a rental and in a portfolio. Are those the 2 like major scenarios that you're seeing your best successful investors use hard money for?
Oftentimes, yes, but not exclusively. So when there's value add construction, that's more than, paint and carpet. That's the first part, because it doesn't, well, you can buy a house with conventional loan with a lot less out of pocket. If you're spending 10 or 15,000 in rehab costs on this thing, it's going to be less expensive, but generally value add is one. Recently, I've been fielding a lot of calls from people that are looking at commercial properties. If you haven't looked in the commercial space lately, you'll find that commercial financing is a total nightmare. Since about 2023, this is that's a whole side conversation, but it's very difficult to get financing for commercial properties right now. And as a result, people call us with some cash that are looking to buy, more valuable properties. In cases like that, it's kind of a waiting game where, it will take us on a commercial property, we can close in as quickly as 2 weeks. When, a more conventional lender, you're talking 60, 90 days easily to get through that process. So, people call us for quicker liquidity. And I've been doing more and more loans where, somebody buys a property at a low price, or maybe not even low price, but they buy it because they have the cash and they want to move quickly, and then they don't know how to finance the renovation. And so we come in as a fund the construction on the project, things like that. But value add, oftentimes the last point where this happens a lot is when we have somebody that, I'm working with a guy right now in Gettysburg, right? He is negotiating this property. It's a small multi-family, ready to rent out. One side's occupied, the other side's not. Well, he's buying it at a number that's about half of the value, right? And he knows that going in. Well, he's using hard money so that he can get control of that property, and in 90 days he can get a DSCR loan for based on the appraised value, not on the purchase price. And so he's going to end up taking out $75,000 in 3 to 6 months from this property, and it's still going to cash flow. It still makes a lot of sense, where we end up being a bridge. So he buys it, he's putting some money down, and then he's going to let age the property and let it sit there a little bit, and then refinance and get some capital out of it.
Makes total sense. Value add and bridge are kind of the big ones. Bridge lending to get to a different loan, or just to close on a property, and then if it's more valuable. Just real quick, out of my own curiosity, when you're talking about commercial properties, are we talking about multifamily, or are we talking about commercial as in like office,
All
or
of them.
both? And then I'm also curious, LTVs on those properties for yourself. What is the LTV? And for those that are listening that don't know these terms, loan to value. I'm just asking, how much for the properties value is Josh going to loan on? Is that
so? That's a great question, and it's so stinking hard to look at. I hate when people ask me, what's your loan to value? What's your, interest rates, all this kind of stuff. At the end of the day, we're going to look at the project, look at the borrower. Usually our commercial bridge are somewhere between 40 and 60% of loan to cost, as opposed to loan to value, because oftentimes when you have somebody buying these things, a lot of the value in these properties are based on the cash flow. And so they're buying a distressed property that might be vacant or partially occupied. And so there's no real value there until it's a stabilized asset. And that's one of the reasons why we're based on cost.
It makes total sense. I don't want to go down that road because
sorry.
It's not what, no, it's not. You're totally fine. If the audience caught that, great. If they didn't, this isn't the video for you.
That's right. That's the whole other conversation.
We're mostly talking about like small multis and single family homes. So when we talk about speed, structure, strategy, and like breaking down a deal, I know you mentioned it before, but I just want to ride the point home. How quickly can an investor typically close with hard money versus a bank?
I can only speak about our hard money product. Okay. Because I've seen hard money take a month. I've seen people do it in 2-3 weeks. We originated a loan. I went to the beach on Thursday night, and at 4:50 on Thursday, I got a phone call from an investor that had already gotten an extension on the loan. They had to close Monday. I was going to be gone until the end of the day Monday. Right. From 4:50 on Thursday night until, I don't know, Monday afternoon, we put the entire loan together, underwrote it, got our physical valuation. And I told them, because I was going away, we probably couldn't close till Wednesday. We ended up closing today's Thursday, right? So we closed Tuesday. We closed Tuesday, right? And that was not a great situation. If I get the call at 10 a.m., we probably close that loan Friday. We have a really good team that knows exactly what they need and what needs to get done prior to closing. And when we have the need for a very short time frame, we can jump and move and, get everybody moving in the right direction and make it happen pretty quick. We've closed loans. My partner Ian's closed a loan in Philly like 2 years ago that originated at 7 a.m. and we closed before 5 p.m. the same day. That's not typical, right? Usually a week, 5 days is pretty typical with us. But if you need to go fast for 24 hours is definitely possibility.
Yeah, you just got to bring it up.
So I mean,
case by case scenario.
You figure,
and it also is investor dependent. If you don't have your ducks in a row, you don't have your paperwork, or you're not signing stuff. That could also, it's not necessarily all dependent on you guys can do what you can do, but if you as an investor don't have your paperwork in order or can't sign documents in a timely fashion, then it might take a little bit longer. Common mistakes investors make when using hard money, like over leveraging themselves or maybe like not understanding the fees. What do you normally see here?
It's a couple fronts. I mean, I think the biggest mistake from the investor side is not understanding the risk, right? You buy a flip. What's the first thing you do when you're renovating a property?
I buy a flip and I renovate a property.
Like first step of construction.
I mean, I blueprint the property first. That's
Fair
what I
enough.
do. But then I call out the GC and we go over the project.
Okay, here's where I'm getting to. The first step in construction is demo, right? So day one that construction starts, the property loses value immediately, right? And so, everyone has the best of intentions of getting that property, turned around in 60 days and it looks beautiful, it sells for 20% over market and all that kind of stuff. I think people have an unrealistic expectation, number one, of the risk, and number two, of the difficulty of managing contractors. Because, right?
I mean, you're gonna go there.
Well, I know. That's my background.
It's good. This is tough. Contractors are super challenging. And once you find an A-player contractor, you're going to know, wow, I got an A-player contractor and this is gold, and you're going to be living life and everything. You can have crappy systems. I always talk about, you can actually have really crappy business systems, but if you have an A-player contractor, they kind of fill all those gaps and it's like, okay. And then if you had a bad contractor, your bad system's like, wow, everything's breaking. Things are not going on time. And so, sorry, I totally.
It's great.
So
my son's going to
is one of your biggest things that that investors kind of underlook, and they don't understand the people problem. Like, hey, I got to manage these guys, they're people. And if I get a bad person, everything's gonna be messed up. Or if I pay my contractor, for instance, I think I had this happen recently, not on me, but another investor who was like, I paid the contractor $17K like day one. What? Why did you pay him $17,000? That's like contractor 101. Like, don't do that. Or your project's gonna take forever. And he's like, it's taking forever. You paid the guy $17,000. He has no incentive. Sorry.
No. You got to keep. You always have to have leverage. If you don't have leverage, you're not in control of the situation. And it doesn't. The whole contractor thing is a very long story. And I think we set ourselves up as a society for a situation where we have really good contractors that are super expensive, and then there's everybody else who's just trying to make a living, and they're probably not the highest quality workers that we could have in those spots. And so, it is what it is. You deal with it and all that kind of stuff. But managing the construction project, finding the good players and keeping yourself ahead of the leverage and ahead of the problems is really a big one. The other side is we've been living in a continually appreciating market for 15 years. And a lot of bad flippers have become industry moguls and real estate gurus all of a sudden, even though they never hit their construction budget. They're buying over, what the numbers tell them to on properties. But by the time that house is renovated, the market's appreciated enough that it can absorb a lot of those losses. And I think that if people looked at, number one, their calculations on their first deal and compared it, like the first deal that you're going to do, you are going to screw it up. And there's nothing wrong with that. Like, as long as going in that you're not going to make 50 grand when the number says 50 on the spreadsheet, like, you're probably not going to make that. And it's all right. You're going to have a $20,000 mistake and you're going to learn. And then the next one, you do a little bit less mistakes and, you get better and better. But we're dealing with big ticket items. A small mistake is $5,000 or $10,000, and if you're not prepared for that, it can stop your rehab right in the middle of the rehab. Your guys are walking off the job and now they go take another job. And by the time you got those good contractors back, you're 2 months in with no work done. And so, like, I just think that people go into, look, I did it. Lost money on the first 3 flips, right? People go into these with the best of intentions, but without looking at, hey, these are some things that can go wrong. How am I going to mitigate these problems when they actually occur? And the people that have the most success are the ones that realize it's not going to be smooth sailing. It's going to be hands-on, and the first one's going to take longer and cost more and all that stuff. But if you make 10 grand on your first deal, you're going to do a lot more. If you lose 10, you might never look at real estate again. And I try to, when I talk to potential clients, is like you're saying, I try to go through it and say, you said you can get 250 for this property. I'm looking at all of the sales in the last 5 years, and the highest sale is 230. And you might be right, but I can't lend on that 250 value when the numbers say it's 220, So yeah.
There's speculation there. With that said, you guys have done a ton of loans. How many?
Yeah.
Do you know how many loans you guys have done in total?
It's
full cycle loans?
4,000 something
Okay.
like that. Like,
You've done a lot of loans.
enough.
I'm
Yeah.
actually curious. I didn't have this question queued up. Do you have a Rolodex of like, hey, do you know like a Rolodex of contractors where if a borrower is struggling, you go, hey, reach out to Joe, Andy Stack, blah, blah, blah. He crushes out 20 renovations. No? Yes? I'm just curious.
So watch this.
Can you save
There's
somebody that has a contractor problem? This would be like gold.
Dude, I
This
know.
hard money lender can also pair you with an A-player contractor. Boom, we got gold nuggets right here.
There is only one person that I recommend, and he's an insurance broker in Lancaster. Because no matter what, I'll tell you something happened earlier this year. Yes, that's exactly right. Ryan Dahlberg is amazing. He is amazing. Red Rabbit is the best insurance company, and like I can't stop telling people about that. Like he's amazing.
I've interviewed Ryan, so. But that's
he's
awesome.
on point.
It's also probably, I find it really hard to, because people can change, and it's really hard to say, hey, you can use this contractor, and then the kind of the onus and the risk falls on you as the recommender. If something happens, like Dave recommended this guy, and he's taken, I feel like you never get rewarded for referrals. You only get the hate mail of like, this guy like missed the spot on the ceiling. I'm like, he did your whole house.
Right.
Go up there and touch it up, or go tell him to come back. Why are you calling me? I don't need to know.
And it's not just contractors. Contractors, they take the brunt of it, right? But like we have a title company that we will recommend if somebody doesn't have any, right? Okay. And we were doing a loan for a woman up in northeastern PA, and she didn't have a title company, so we recommended them. Everything went great. Something got missed on the title, and there's half a lot that never got transferred. So when she went to sell, it held up the process for a month and a half. She lost the buyer, and all of a sudden I'm the bad guy. And it was like, listen, I didn't do the title. Like they gave you insurance. Everything was, above board. But it is exactly what you're saying. It's like you work with good vendors, and, look, I'm not 100% all the time. Like I can't expect perfection from everybody, but it's hard in the contracting space, especially. I would love to say yes, but I don't have anybody I can throw out there today.
No worries. That's very few and far between. Come talk to me if you guys need a lender. This is a good, real quick, if you're an investor, like building a team, you want those A players, you need funding partners like hard money bankers. You can check out our free preferred vendors list at realestatehackers.com. I promise you, I actually did not set this up to be a pitch, but it's got vetted lenders, insurance pros, property managers, basically a Rolodex that I wish I had when I grew my 52 unit portfolio. So you don't have to build it from scratch. So totally wasn't queuing that up, but
no. Listen, we're trying to be, I've been talking to Chad for 3 months about sponsoring his event. So hopefully we'll get on the vendors list.
The perfect queue up right there. It didn't, it's interesting there. Let's talk about, this is what I talked about before the call. I wanted to get into a specific deal where hard money helped an investor win. So let's break down one specific deal. Let's chat numbers about how the hard money helped this investor win. Do you got something in mind?
So I have a client in Tobyhanna. She flips about 12 properties a year. And the first deal that I was working with her on came from a broker. And I'm not going to use that first deal because it was a while ago and I don't have all the numbers, but I'll give an example of our typical deal, right? So she buys, if you're familiar with Tobyhanna, it's a lot of vacation rentals, either vacation rentals or vacation homes and gated communities. And then you drive outside of those gated communities and you don't see another human soul for another 20 minutes driving down the road, and then there's like another one right down here. It's a pretty cool community, but She will buy properties that have been sitting on the market. And actually, this is a really good tip. This is what I've found for investors that are looking for good deals. Look for stuff that's been sitting on the market for 6 months. There's a reason it's on the market, and usually it's overpriced. And if it's too overpriced, it means they've gotten 0 offers or 0 looks. So make an offer at the number that makes sense for you. And you might be the only one playing the game. So anyway, that's what she does. So like these properties will be listed at 200, 220, and she's offering 130, 140 on the properties. Now the 220 or 200 asking price is a ridiculous number because the ARV on paper for these things is about 240 to 270, let's say. And when I started working with her, I said they were worth 240 when she was done. Right. So her numbers look like this: buy for 140, put 35 to 50,000 into them. Let's say 50. And now she's in at 190. Yeah. And on a 240 sale, that looks pretty good. But if she sells at 240, it's going to play out to probably about 20,000, 25,000 by the time she takes into closing costs and lender fees and holding costs and all that stuff.
And so how long is she holding these before flipping them? How long, how long is Hard Money Bankers involved here? 3 months?
We make all of our loans for 12 months.
Okay.
We want to see 3 months of interest. So after that first 90 days, there's no prepayment penalty on it. So like people are in, for 3 months, 5 months, whatever.
Yep.
She has been consistently finishing renovations in about 2.5 months and then closing in the 4th month.
Love it.
All right.
Okay.
Now, here's where she really excels. Hard costs are 190. Real costs are like 220-ish, let's say. And on a 240 sale, that's not a lot of money. 20 grand, not great. Her first property that we did with her was a larger house and the numbers were a little bit different. But then the second one, same figures came in. She sold it for $299.9, which is 20 or 30 grand higher than our highest estimate. She's now selling these same properties for $340,000.
All right. So she's making a $299.
She's making 70, 80 grand.
Making it's probably like 65 after like real estate commission. Maybe 60, 65, which is amazing. Whatever. We go conservative with like real estate commissions and stuff like that, which is still really good. 60. If you're making 60 to 65 every deal, you only got to do 3 deals a year and you're almost touching $200,000. That's awesome. I love it. And so she's selling these as she's setting them up as basically like short-term rentals, or she's just selling them and
she sets them up as short-term rentals with furniture when she's selling them because she knows her buyers are New Yorkers who want an investment property that they can come and hang out and, spend the weekend or spend a week down there in the summer or the winter time. Right?
Let's be honest, Josh.
Yeah.
It's all an ego. I got this property up here. When you talk, I'm staying at my property. I had this conversation with somebody where sometimes even even if it's short-term rentals, the numbers don't make sense. People will purchase them based purely on ego to say, I'm going to the Bay House. I'm going to my mountain house. It's cool to invite your friends, but here's your warning from me. My warning is like, still process the numbers. You're still got to actually manage that property. They're harder to manage than a, freaking long-term rental. And so you're still going to have to set up these processes. I'd much rather be in your girl's position, making the 65K and then going and renting once a year, an amazing property that I never have to worry about the maintenance on, but doing her method. But I find that she's also riding this huge wave of professionals that also get like a huge write-off. They don't have to be real estate professionals. This is all tax stuff. But if you just want to lower your W-2 income, this is a big strategy. I know there's a guy, Carlton Dennis. I don't know his last. Carlton something. Maybe Dennis Carlton. But he's a huge YouTuber. This is his strategy, like buy these huge short-term rentals. And I feel like it has taken over the market for people that are like, I have a high income and I do not want to pay taxes. And so I'm just going to buy short-term rental. Eventually that's going to bite him in the butt because you still got to run a property or it's going to get run into the ground. It goes back to the managing the business factor. But I love this strategy. I love those numbers. And it shows that with that hard money loan, she can do the renovation. She probably doesn't have all the cash to do the renovation, do the purchase. And so she's using this to leverage. And then she's doing an awesome kind of creative strategy where it's, slightly different. I mean, people are not taking these, luxury homes and flipping them like as a mainstream thing. So she's found this kind of niche, which is awesome. I really
That's
appreciate
right.
you sharing that. That's a
Yeah.
gold nugget on multiple fronts for whoever's watching. Take note. That's an awesome strategy. Sorry, investor in Tobyhanna, that we just increased your competition.
She's already training people up there to do it anyway, and I've
Okay.
started lending to her clients now too. It's
Oh, love it, man.
symbiotic relationship. It's great.
Yeah, I love it. Let's shift gears. How smart investors, which you actually just explained, use hard money to scale up. And so
Yeah,
the question is, how do most successful investors you work with use hard money to scale larger portfolios?
sure. So I'm going to put a big asterisk here. I had a long
Sure.
conversation about this yesterday, and unfortunately, I have done this wrong twice. Uh, Scaling, you don't, when you're looking at, let's say you do 4 or 5 flips a year. I mean, you
Mhm.
can make a good income if you do the right properties and you execute well. You can make $300,000 off of 4 or 5 flips. With that being said, when you go from 4 or 5 flips to 10 flips, and then you go from 10 to 20 in that same time frame, the money is probably not going to be the limiting factor. It's very likely that that limiting factor is going to be the contractors, and it's going to be the middle management oversight, the actual site visits, because if you're doing 10 or 20 units a year, you're going to need your focus somewhere else. So let's assume that you have that taken care of. In that type of situation, people will use us for in a number of different ways. I have a client in Lancaster. He buys cash with everything, and then he runs out of money. And he'll call me and he say, "Oh, look, I'm looking at buying this property." And we're able to put together a situation for him where, he might have to put up 2 or 3 properties for collateral, and, 2 of them are under renovation and one he's buying, let's say. But we're able to give him enough cash to buy the new property, fund the renovation, and probably take some money out of that. And so that he has some cash flow until one of the projects is done. And he won't call me on every project. When he has cash, it's going out and it's going to be invested. But when he sees an opportunity and he says, "Okay, well, I don't have any cash for this. I want to jump on this deal." He's got enough equity in the existing projects that he can pull that cash back out and put it to work. And so, like, that's a great use of hard money.
Probably a great client too to work with.
Oh my gosh,
He's
she's
got his
awesome.
own money to
Yeah.
already do it, so he's got a lot of stuff. I do wanna come back to collateralizing,
Yeah.
something that I have not talked about, and I think
Okay.
that's important, especially
Well,
for
let me
successful
let me do
investors.
2 other situations, and then we'll
You're
go
good.
back to collateral. Okay.
Yep.
So the second example, we're scaling. I've been talking to an investor out in the mainline area outside of Philly. Right. He just made $480,000 from a sale that happened earlier this week or late last week. But we're looking at like 5 other projects right now that he's bidding on and negotiations on, and that 400 grand, it won't cover one of them. So he's looking at taking, $400,000 and putting money into each of the properties, but also keeping some of that for himself, because it's nice making money on paper. It's better when it's in your account, right? And so, we had this long discussion about this project. You're going to need X amount down that project, and he's doing some projects that have large rehab budgets. So bottom line is he's going to need money down on every property. In some cases, it's going to be 10%, 5%, because it's a great deal. On other projects, it's going to be a heck of a lot more because the risk is much higher. And he believes that the sales price is going to be, for a round number, let's say it's 750 and my numbers are at 650. It doesn't mean he's wrong. It just means we don't see the same things,
Just
and
means you guys
so,
are gonna be a little bit more conservative, which is
yeah,
appropriate and
exactly.
expected to the lender.
And exactly. And without, especially I mean, he's adding like a house to to an existing structure in this rehab project. Well, like that can go wrong in so many ways. And so I can't 100% bet that that's going to turn out well. The
Yeah.
most common way that I see for people to leverage what they have, I talk to people every single day where they've got, $200,000 that they continually cycle through these properties that are worth, 250 when they sell, and they're able to buy them for, let's say, I don't know, 150 and and put 25 into them. And now they're making some decent money on these transactions. Taking a step up in asset class eliminates an awful lot of other investors, right? I mean, you get into that $400,000 or $500,000 resale value, you need capital to put in there. So, that's one way to expand your business. And it's a great use of hard money. Or to take that $200,000 and split it into, let's say, 3 or 4 of the same type project, same cookie cutter stuff you've been doing before, but now instead of just doing one, you can do 4 or 5 at a time. And so it just, it allows you to leverage that money that you're already using. Are you going to make less per deal? Probably a little bit, but across those 4 or 5 projects, now you're making 3.5 times what you would have before for the same level of risk, or maybe even less, because you've got it spread across a number of properties.
Yeah, I love that. I also think, you touched on it before, and you said that you kind of cautioned investors to walk before they run, which definitely is always a good cautionary thing. Don't just start scaling up like crazy and try to put a bunch of properties under contract. I just spoke to an investor today, and he had purchased like 2 properties spread out. And then he was like working through the renovations, and they were taking forever, way longer than he expected.
Yep.
And I had to kind of put him in check and be like, hey, you're not getting another property until you finish these 2. You understand that, right? And he's like, yeah. And it's sometimes like, hey, dude, if you can't do these first, don't go on to do the next one. You got to finish the renovation here and make money. Get this property getting cash flow before you move on to the next. And so I think it's just really important, if you're going to think about going from 2 to 4, those are big jumps, and people can break. Contractors can break. Usually money's not breaking, but the people are breaking that are working, whether they just can't take on that added because they don't have enough subs. And so projects sit. And when you have projects sit, you also have added risk. I found I am always like paranoid. I'm getting my properties done as fast as I possibly can because I'm worried about break-ins with people seeing contractors. I'm worried about them stealing HVAC units. And then that totally crushes projects. Is like, wow, that actually could have a lot of margin. And so getting things done quickly is definitely a skill that I see the most successful investors are really good at. And the ones that flounder just take their time, 8 months, 12 months on a renovation, where it's like, hey, dude, we got to speed this up somehow. I don't know what you're doing, but probably working with the wrong people is probably what it is.
Well, and on that note, you get into a hard money loan. It's interest only. So you're not paying down the principal. And when you get to 8, 9, 10 months, it's eating a lot of the profit of the deal. And it gets to the point where, like, is this going to be profitable or not? To your point, you get that done in 3 months. It doesn't really matter what the interest rate is. It's negligible. You stay in it for a year, it gets expensive fast, and that's something that people never really think about. They don't think about their per diem rate for interest or taxes or, any of the other things that go along with that property. And if they did, it would change things.
Usually hard money lenders say, hey, this is not a long-term solution. That is what the hinders is. Hey, this is for short-term. So if you're not doing in 3 months, 6 months, this is not the product that you should be looking for. So investors should know that up front. As far as exits, I know we briefly chatted about this before the call. DSCR product, I'm a investor. I'm purchasing a property. I'm coming to you. I'm saying, hey, Josh, I don't have a DSCR lender. If you guys want to learn about DSCR loans, we got a great video. I'll link it in the bio so you can understand what DSCR. I don't get into that in this one. This is about hard money. Do you have somebody that you can recommend, or somebody or where investors
100%
so they can get that 30-year fixed lower rate? It's not hard money.
Absolutely. So full disclosure, I've worked with a bunch of brokers for, a long time. And what I have found is that if I do an intro email, nothing happens. If I do I send somebody a lead with contact information, everybody misses each other. So essentially what I've done is if somebody calls me about DSCR, I walk them down, I'm going to reach out, I'm going to get a quote, and I'll put it in front of them. And like, this is the good, the bad, the ugly, if this is something that's interesting, if this will work, great. This is the information I need. Once I gather that info, then I'll hand it off, and there'll be an introduction and I don't disappear, but it makes such a big difference because, like your phone rings 1,000 times a day. And if you're not, right in front of somebody, or if somebody's sending you a referral, of course you're going to call them and reach out, but they're busy too, and it might not be the right moment. It's much easier to walk people through that process, especially when we have a relationship with them. You sent, just like the contractors, you refer somebody out and all of a sudden they don't pick up the phone, or they, don't paint the ceiling right, or, whatever. So I try to eliminate that and walk it through the process. But we've got, a bunch of different options with the SCR. And for that matter, there are other types of hard money loans besides what we offer that, are available out there. And it's one of those things where, again, it goes back to finding the right funding for your specific project. There's a difference between a 640 credit score and a 680 credit score. And depending on the lender, it can be points, it can be leverage, it can be time, and determining what, if you're talking to a broker who's not asking a lot of questions, they're just going to push you into whatever product is there. When people start asking you questions, how's your credit? What's your experience? Have you ever flipped a house before? You've ever done any construction? Or, you start getting into a dialogue with them about what you're trying to accomplish. A lot of times they're going to find a loan for you. They're going to not like push you into anything that's there, but find the best option. And sometimes the best option still doesn't work, but at least you've got somebody working to meet your desired outcome. And like, that's what's really important, I think.
Gotcha. No, I appreciate that. And the key there is that Josh can help you on the back end of getting out of that hard money loan, because that's eventually what's going to happen. Let's talk rates real quick.
Sure.
When an investor is thinking hard money, they're thinking rates. Normally what pops in my mind is 12 and 3, 12%, 3 points, very standard on the street. Talk to me a little bit about rates.
Okay. So again, my least favorite conversation. If you have good credit, right? You have experience and you've got plenty of cash, you're going to get the highest leverage, the lowest rates, the lowest origination costs, all that kind of stuff. Most people are missing something from that calculation, right? Like, it's their first deal, but they have an 820 credit score and they have money in the bank. Okay, we can do, a better rate, but the origination is going to be high and you're going to have to put 20% down on the purchase. If you've got bad credit and tons of experience, what I see across the board is somewhere between 2 and 4 points for origination on hard money, and interest rates between like 9.5% and 15%. And like, you could have great credit, but if you have a property that is rural, 90% of lenders are gone. If you've got I say it like this, like every lender has their own flavor ice cream. Like, they have their own flavor of what they like to lend on. And like, some like nuts and some like Jimmy's, and it is what it is, but the numbers are often play out very similar, where, the borrower is going to be putting down 10 to 25% on the purchase. Interest rates are probably going to be in that 12% range. I mean, it can be, most of our loans are 3 points and 12.99 interest rate. If it's something that doesn't specifically fit, that our loan doesn't work for, or something like that, we've got other options and things that we can, point in the right direction. But there's so many features.
Yeah, you answered it. I mean, I think that just so people what they can expect, and between 12 and 14 or 15, which I think are from 9 and 15. I mean, when you go 1% one way or the other, it really doesn't matter if you break it down to 12 months. It's minuscule,
right,
in the grand scheme of things. That shouldn't be. I mean, often I use who I like most and who I trust. And then once we get in that cycle, you just go and calling the right person. And if they're, slightly above, somebody else, sorry, I'm just going to use that. I'm just going to keep using, because, hey, I trust they're getting it done. This product was for what it is. So I appreciate you sharing all that. When we think about getting borrowers ready to using hard money loans, they want to get a hard money loan today, what documents should they have in place? What should they have ready for you?
Construction.
He wasn't ready for it.
The construction budget's a big one. No, It's a short list. It's a super short list, right? It's like you have a driver's license or government photo ID. If you have an LLC, you need an operating agreement, then organizational, the formation docs and the EIN letter from the IRS, bank statements, title contact, insurance contact. I mean, that's the short list. Here's what can happen, right? And here's what often happens with a more conventional type or bank backed hard money lender, right? You get the initial documents, then either fill out an application online or the broker fills out the information and then you order the appraisal, right?
Yep.
And then while the appraisal is getting ordered and done, the underwriter looks at all the stuff and has like 50 other questions and sends you a list of, we need these things. And then you send those in, and then the appraisal comes back and they finally send you a final term sheet. And it's like, okay, this is what we need to close and that we're ready to go. That's, I guess, process for a lot of lenders. For us, I'm sorry, this is live TV and I thought I turned my phone off, but for us, we do all the heavy lifting up front. If I have a concern about your credit score, like I'm not pulling credit until you've already approved the loan. So if you tell me you have a 720 credit score and it comes in at 710, the loan's not going to change. If you tell me it's a 720 and it comes in at 420, there's a totally different conversation, right? The same thing with construction budgets and things like that, like $50,000 budget, and I go out there and there's no roof and like there's a foundation crack. Hey, we probably are not going to be able to get this done for 50 grand, but a difference of 5,000-10,000, it's not a big deal. What we're often looking for is, first on the property, is this a good opportunity? Are they buying it at enough discount that they're going to make money on it? 2, is this somebody who has the ability and intent to pay me back? And, credit and experience and success in life and success in the business is a big part of that underwriting. But I mean, I've had people send me, a PowerPoint on one property where it's like, oh, here's what we're going to do. Here's the finishes we're choosing. And here's the financial breakdown. There is nothing wrong with that. And that is great to have so that like it shows to me that you have an understanding of the project. But really all I need to start underwriting is property address, purchase price, rehab cost. What's your strategy to exit? Are you going to sell it? Are you going to rent it? With those 4 things, it's at least a jumping off point to see if we have anything to talk about, and then from there, there's maybe some more questions, but I'm a big believer. I started wholesaling, right? We used to get 400 leads every single week. We had canvas teams going all over Philadelphia, knocking on doors and generating leads. And it was great. But I mean, it was a big lesson in like drinking from a fire hose. It's like, you got to figure out what's the important information, and anything beyond that, it's too much because I can't even process it. And so obviously there's more information that's needed, but you can ask some superficial things and some basics that are going to kind of guide the project. And really that's the stuff that is important, I think, for an investor, is figure out what's the most important thing about your project. And, the success or failure is going to hang on that thing, and then do that really well. Right.
No, I love that. I've kept you here for a long time for interviews. So I appreciate all our subscribers that have stuck around for all the golden nuggets. Is there anything that separates the best investor clients from like everyone else?
You've said it a couple of times here, and you probably didn't even realize it. It's excuse my language, but dealing with your ish. Right? Every single business has crap that we don't want to deal with. There are things that are hard and become obstacles. If you know going in that there's going to be obstacles that you're going to have to overcome, things that you've never done before, dealing with the permit office, or figuring out how you can get back in front of a $17,000 deposit on a contractor, or one of a number of different things. If you know going in that there's going to be problems, and also aren't afraid to deal with them, even if it means throwing the guy off a job site, or spending 3 days sitting at license and inspections and jumping through every hoop possible, it's not putting problems on the back burner and being active about it. If you're rehabbing a house and it's your first one, you should visit it every day. You should be able to see progress from their contractors and be able to find out why there's no progress if it's not happening. After you move on to having some project managers and things, but like, it's just dealing with the thing that's in front of you and not kicking the can down the road.
I love that. That's great advice. pushing things through as an investor, kind of that perseverance. That is great. I have not actually got that answer from anybody, so I appreciate that. That's good. If you're, looking to be successful and you want to scale your portfolio, realize that you're going to have to do some things. Even though Josh just skimmed over it, he really hit it home. Sometimes that means, which stinks, we all value our time, but sometimes it means going to sit in the permit office to get an answer and to hold accountability. I know because I've done it. And so
And it
when he
makes you
says it,
so
you might
mad.
not know what that means, but it means literally you're driving to the permit office and you're literally going to not leave the permit office until you get your answer. They're like, hey, if you don't give me an answer, who can I talk to?
Yep.
Who do I have? Who's going to solve this issue? Because what happens in a lot of the governments is they will pass the buck, or that's not for me, or that. Well, then who? I'm not leaving until you tell me who solves this. And so, yeah, pushing things through. That's awesome. I love that advice. How, if somebody's looking to get a hard money loan from you, Josh, you've shared a ton of information. What is the best way for them to reach out to you personally? We'll put all your contact in the description, but if you want to just shout it out, what's the best way?
100%. The easiest way to get in touch with me is pick up the phone and call me, 717-213-8488. You can send me a text there as well. Or if you'd rather send an email me at josh@hardmoneybankers.com. Yeah, I'm always on the phone, always on my email. If you call and you don't get an answer, it's because I'm on the other line. I'll call you right back when I get off.
And you heard it here. Josh is at his, on his vacation, 450. He's pushing this through. Doesn't matter. His wife's going to be frustrated. The kids
That's
are
right.
So he's going to get it done. Call him 24. No,
That's right.
No, I love that. Yeah. If you have any questions with hard money, you can definitely put them in the comments. Please, I will make sure Josh gets them, and so he can respond to them. Or if you have any questions for me, put them in the comments. If this video has helped you guys understand how to leverage and grow your portfolio, give us a like, hit a subscribe, let us know in the comments what you're working on. Are you using hard money in your deals yet? Why or why not? Would love to hear that. Thank you guys for watching. Thank you, Josh, and for coming to Real Estate Hackers. I'm Dave Hathaway, helping you scale smarter and faster. We'll see you guys in another video.
Awesome. See you.